I don't want you to make a tax mistake that costs you $89,954. I know that sounds specific, but I mean it. As you might know if you've seen the channel, I'm a financial advisor, and I'm about to tell you about a mistake I see people make all the time in planning for their retirement that can cost them big money. Today's video is about something a lot of people, and even some financial advisors, often overlook. Where you own what you own matters. Potentially a lot. Asset allocation is something I'm sure you're familiar with. That's how you've divided up your portfolio. Do you own stocks, bonds, mutual funds? How aggressive or conservative are you? That's all about not having all of your eggs in one basket. Today we're talking asset location. Asset location is what I'm about to share with you. That's deciding what egg goes in what basket. So I'm going to show you something from a fun little website here called Stockulator. It calculates historic returns on individual stocks. It's kind of a fun thing to play around with. I'm going to use an example from my neck of the woods from Cleveland, Ohio, which is Sherwin-Williams, the paint company. They're based here, so it's a stock I've seen a lot over the course of my career. Now, a note for the compliance folks, if you're watching the video, I'm not telling you to go buy Sherwin-Williams stock. It's just a good example of what proper asset location can do inside of a portfolio. So come with me, let's hop in our time machine. We're going to go back to the year 2000, January of 2000. What a fun time that was. We all realized that Y2K wasn't going to end the universe. Cell phones had those funky little downloadable ringtones, and you had to pay monthly per minute for a cell phone plan. You guys remember free nights and weekends? What a time to be alive. That sounds like a billion years ago. Here's the thing, Sherwin-Williams was running $6.44 a share back then. So let's say you went back in the time machine, you decided to put $10,000 into it, you just changed jobs, so you got this IRA money burning a hole in your pocket, so you log onto your online trading account, because that was also new in 2000, and you buy $10,000 worth of stock, and you go for a ride. And what a ride it's been. As of the recording of this video, that $10,000 is now worth $723,674. Quite a hot stock tip. Here's the rub. It's sitting in your IRA, which means that eventually you owe taxes on the whole 723 grand. Now let's go on another trip. Let's get back in the time machine. Go back to the same time. Let's assume that you bought the same stock, the same amount of the stock. It's worth the same amount of money today, but you bought it with after-tax money in your brokerage account instead of in your IRA. To this point, you've paid taxes on $44,000 in dividends over the last 24 years, and you've got a long-term capital gain of $487,000 built into the stock. Now let's keep this simple and assume that you're in the 24% federal tax bracket, and you're going to start cashing this stuff in over the next handful of years. In the IRA, you've got 24% tax on the whole thing at some point in this case, on the whole $723,674. That's essentially $173,681 in taxes that will be paid. But remember, we went back in the time machine a second time. You were smart. You put that egg in your brokerage basket. So you've had to pay tax on $44,000 worth of dividends at 24%, and you've got a sizable long-term capital gain, $487 and change thousand dollars, that you're going to pay 15% on. So your total tax bill is going to be a little north of $83,000. That's a $90,000 difference on the same money. Put another way, you went from an effective 24% tax rate on that purchase to an 11.6% effective rate. You cut your taxes in more than half, not by what you owned, or by when you bought it, or by when you sold it, but by where you held it. As a general rule, look at your asset allocation on a total portfolio basis, not on an account by account basis, and do things like putting your growth assets where they'll get the most preferential tax treatment. Think about this in two terms, growth versus income. Growth tends to be more tax efficient. Think here about stocks that don't pay dividends. How do they make money? Well, you're counting on share price appreciation. The stock price will go up over time. That can be deferred into a long-term capital gain category. Now, on the flip side, income. Think about things like interest and dividends. Talking about things like bonds or REITs, real estate investment trust stocks. Generally speaking, not very tax efficient here because most of the potential gain that they would earn are interest and dividends, which oftentimes generally are taxed at income rates, not long-term capital gains rates. From a mutual fund standpoint, passive funds with lower turnover likely means less taxable gains on a year-by-year basis, as opposed to a more actively traded fund with a lot of turnover. You can also look at ETFs or exchange traded funds as potentially being more tax efficient. They're taxed much more like an individual stock, which gives you control over when you're going to pay the taxes, as opposed to an active mutual fund where it's going to be at the manager's discretion. Now, we can go on for a long time with examples here. Suffice it to say two things. One, if you're a DIYer, study up on asset location if you haven't already, and look for ways to optimize the eggs in your baskets. And two, if you're working with an advisor, ask them how they've structured your portfolio to take advantage of asset location. And if they don't have a good answer for you and they can't show you what it is that they've done, might be time for a new advisor. While you're brushing up on your financial education on the internet, I've got you covered. I got a great video for you right here. Go ahead and check it out, and I'll see you on the other side.